Welcome to the Thomson Reuters Idea of the Week and Alpha Now. I'm John Cozy. The Japanese equity market has been up with the hope of better economic growth for the country and the introduction of Prime Minister Shinzo Abe's so-called Abenomics program. His plan to turn 1% deflation into 2% inflation has moved equities in blue up 18% and twice as much in red if you hedge yourself against the weakening yen. Are Japanese stocks still a bargain? Let's look at the pros and cons, starting with the cons. Short-term Japanese government bonds in blue and long-term JGBs in orange have been low since the 90s. If the economy improves, higher interest rates could overload a government which already spends 40% on debt service. Under this scenario, debt service could jump to 80% of Japan's budget. That would result in yet more challenges for the government. Worse yet, it could reduce confidence in Japanese investments. Another possible con is how Japan stacks up compared to developed peers in the Asia-Pacific region. StarMine shows that Japanese equities have the highest price-to-intrinsic value ratio of that group. Another con could be a weaker yen. While helping exports, here's a country that shuttered all its nuclear power plants and now spends 7% of GNP on energy imports. Price increases could weigh heavily on industry and erase a good portion of the cheaper yen benefits. The orange line shows gross public debt is over 200% of GDP. Import price hikes could slow GDP, pushing that ratio higher. Now, on the pro-equity side, compare the Nikkei 225 performance in the blue line to the huge run-up in the Japanese 10-year bond. Relatively speaking, there's a lot of room to move for equities. If Prime Minister Abe is successful in getting more young people working, they'll buy more goods, and that could help stocks. Right now, national unemployment stands at around 10%, but it's twice that for the younger workforce. IBES forward PE ratios seem attractive too. The blue line for the last 10 years stands at 14 times, still below the median 16 times line. That could change depending on whether analysts revise earnings estimates higher or lower. So how could someone get involved in Japanese stocks as a bull or a bear? One way is the highly liquid iShares MSCI Japan Index ETF, the EWJ. It's up around 17% in the 5 months since October 2012, even with a weakening yen. The red line is the Wisdom Tree Japan Hedge Equity Fund, the DXJ. It's up twice as much, but does carry a bit of a value stock bias. For the Thomson Reuters Idea of the Week and Alpha Now, I'm John Cozy.